Monetary Policy Committee and its decision are a key factor to understand that the how economy is doing and what economy can expect. And this is exactly what has come out in recent RBI MPC, where they have not just keep the repo rate unchanged, but at the same time they have also talked about 5 big risks that Indian economy might have to deal with. Hello everyone, welcome to Vajiram and Ravi /news. My name is Shubhangi Singh and today we are going to understand that what exactly the Monetary Policy Committee has brought in front of us. So let us begin with understanding that what exactly has unfolded as of now. So RBI MPC meeting concluded yesterday and the first major thing that came out of it was the fact that the repo rate remains unchanged. That the repo rates remains unchanged at 5.25%. Now in this context, RBI has given different reasons to it, but at the same time, RBI has also flagged 5 risks that stand in front of the Indian economy. So the first thing is to understand that what exactly is the theme that has been understood and kept in mind. So the theme here is cautious pause amidst the global and geopolitical risks that are in front of us. And that is why Monetary Policy Committee has taken the decision of status quo. Things will remain the same. The policy stance has been kept very simple. We will be data dependent. We will read the data, understand what is unfolding, and we will be cautious. We will be vigilant. And all of this is why? Because we see Iran conflict ongoing, we do not see an end to it, and we know how much it impacts our country, our imports, our exports, and furthermore the environment of global uncertainty that has been, especially in the past 1.5 years. So given that, RBI has very cautiously decided to pause and remain data dependent. So in this context, the first thing that we will start with is understanding repo rate and then why it has been kept stable. When we are talking about repo rate, it is one of the instruments that RBI uses for controlling the monetary supply. So the monetary policy instrument, repo rate, one of them. What it means? It is the rate at which RBI lends to commercial banks. Now when we are talking about this lending, how does it happen? So repo word is for short of repurchase. Now the term repurchase is present here because when the bank, commercial bank is taking loan from RBI for short term, they have to keep government securities as collateral. So in this regard, the borrowing bank will later repurchase these securities at a given future date. That is why the term repurchase agreement and shorter is repo rate word comes in. The whole idea behind keeping a repo rate is that it directly helps in controlling inflation and liquidity that is present in the economy. So if we want to understand that how it affects, now let us look at this. In a scenario, there is increase. So if the interest rate is increased, there will be decrease in inflation. So if interest rate is increasing, inflation will decrease. There will be always a standoff between two of this. Why this will happen? If the interest rate is increasing, money circulation which is present in the market, that decreases. People would like to save their money, interest rate is more. At the same time, people would like to borrow less because interest rate is more. So if the money is limited, then borrowing will be expensive, keeping money in the bank account will be rewarding. In this scenario, when there is lesser money in the economy, the demand for goods and services decreases. Now when the demand for goods and services increases and supplies are, the price also decreases, that's why declining the inflation. And vice versa scenario if there is decrease in rate. And in this scenario, repo rate which directly affect the interest rate because this is the policy benchmark rate. Monetary Policy Committee which is responsible for setting the policy benchmark rate, that is repo rate, for ensuring that inflation remains at 4 plus minus 2%, that means in the range of 2 to 6%, and if for 3 quarters it is not in the same range, then they are answerable to the parliament as well. So in this context, MPC has to take this very decision which will not only be about the policy benchmark rate, but also inflation, which they are responsible for controlling. So as of now, because there has been no rate hike, that means there will be no tightening of the policy, and because there has been no rate cut, that means there will be not more money that would be sent into the economy, and that is what we mean by status quo. Now that I am talking about MPC here, MPC has ex officio chairman, that is governor of RBI, and it is a 6-member body. Can you tell me in the comment section the composition of these 6 members? And please remember, MPC is a 6-member statutory body which is responsible for determining India's benchmark interest rate to maintain price stability and also support economic growth. So in this context, I have told you what is the interest rate setting they do upon, what is the inflation targeting, and also the accountability part. Now straight up, let us move to understand that why did RBI decide not to move it. The first simple reason that as of now, inflation is not fully anchored. That means the inflation is not fully controlled. So if there was a cut, inflation could have shot upwards. And if there was an increase, in that situation, we could have some effect on the growth, on the demand part. So the fuel uncertainty, given especially what we are seeing in the Iran scenario, and the food inflation being volatile, we don't know where inflation is situated, and it might drastically variate in coming time. And that is why RBI decided to be cautious and look what happens. Apart from that, as of now, without any rate cut as well, we get to see a clear strong growth momentum. As of now, as per RBI MPC itself, 6.9% growth is predicted. The domestic demand remains stable even after global uncertainty, and apart from that, we are also seeing that the rate cut that was provided before this, that has not been fully transmitted. So if you want to understand the transmission, let's go back to this given diagram. You'll clearly understand whatever instrument RBI is going to use, that is going to affect the operating targets, short-term interest rates, then intermediate targets, that means short-term and long-term interest rates, and then it impacts the economy across. So the transmission across the economy takes a lot of time, and the transmission is still going on for our economy. That means the past rate hikes as of now are still impacting the economy, and the true effect is yet to be seen. So as of now, given the global uncertainty, RBI decided to pause. Now in this context, RBI gave us more information with which we started that RBI talked about there are 5 direct risks that we need to be alert about. RBI talked about that how the Iran situation is showing us a oil price shock, and when we know that India imports such a huge amount of crude, in this situation this shock and its period remains uncertain. Apart from that, this very shock is going to be responsible for the resurgence of inflation. Fuel is going to get expensive if this situation is not controlled. That will lead to expensive transportation, and that will lead to more difficult prices in terms of food. So this is going to get a direct impact on common man. This is going to create a direct impact on the demand in economy and an impact on growth. So as much as we want to understand that what has happened and what RBI is doing, this is something that needs to be understood for the future, because RBI has already highlighted this. For example, another thing that has been brought that we have been talking about in our previous session is the external sector stress. We are seeing extreme rupee depreciation. In past 15 days, rupee has gone and touched 95 per $1. At the same time, current account deficit is widening. Our exports to West Asia have been stopped. We have discussed this in detail, especially for basmati rice exports, and many other industries are suffering in the same way. Apart from that, the imports are more expensive. So this is a double burden, and because of this uncertainty, the capital outflow has been higher. The kind of crisis that we are seeing, this is another reason that we are seeing rupee depreciation. And all of this is something that India needs to be prepared for. Apart from that, RBI has also highlighted that how this is a time for supply chain disruption. This is not just about Strait of Hormuz, this is also about other important choke points such as Bab-el-Mandeb Strait that we have discussed. This is also about Suez Canal. When we are talking about the conflict region and every supply chain across it being affected, and how India is going to see an impact out of it. What are your thoughts on this? Let me know in the comment section. As of now, in the coming days, the only thing that RBI has said that they will practice in approach is to wait, understand what is unfolding and then respond. And that is why they want to focus on preemptive risk management rather than reacting to all of this. Because as I said, RBI is responsible not just for deciding how our currency is going to be managed, but a lot more in form of inflation targeting. So in this context, they have decided to understand inflation and move from just inflation control to risk management, but at the same time without compromising on growth, without letting inflation go out of hand, and keeping in mind how global waves are traveling across. Now on this note, I will be leaving you here with a prelims practice question. Let me know the answer in the comment section. That was all from my side. Thank you so much.